Welcome to our video on the 2001 stock market crash. In this video, we will take a look at the causes and effects of the crash, as well as the actions taken by the government. Don't skip the video, let's begin. The stock market crash of 2001 was preceded by the dot-com bubble of the late 1990s, where internet-based companies were heavily invested in, many of which proved to be overvalued. This, coupled with Federal Reserve's low interest rate policy, fueled speculation and risky investments, creating the conditions for a crash. The dot-com bubble, which was characterized by a frenzy of investment in internet-based companies, had a significant impact on the stock market. Many of these companies were overvalued, and when the bubble burst in 2000, it set the stage for a market crash. Additionally, Federal Reserve's interest rate policy, which kept interest rates low, fueled speculation and risky investments, creating the conditions for a crash. Furthermore, the economic downturn in 2001 was caused by a combination of factors such as rising oil prices, the bursting of the dot-com bubble, and the September 11th terrorist attacks. Corporate frauds were also happening around that time, which can be considered as a factor for the crash. The crash itself began in March 2001 and continued throughout the year. The Nasdaq, which was heavily invested in technology stocks, suffered the most, losing nearly 80% of its value. The Dow Jones Industrial Average also lost over 20%. Individual investors, who had invested heavily in the stock market, saw their savings disappear overnight. The impact of the crash was widespread and had far-reaching consequences for the economy. In response to the crash, the Federal Reserve and government took several actions to stabilize the market. The Federal Reserve lowered interest rates several times to encourage borrowing and spending. The government also provided financial assistance to struggling companies to help them stay afloat. These actions helped to stabilize the market and prevent a complete collapse. The aftermath of the crash saw a slow recovery in the stock market, and it took several years for it to regain its pre-crash levels. The crash also led to increased regulations for public companies and their financial reporting, such as the Sarbanes-Oxley Act of 2002. The stock market crash of 2001 serves as a reminder of the importance of understanding past financial crises in order to better prepare for and prevent future ones. It also highlights the importance of diversifying investments and being cautious of risky investments. It also showed the importance of regulations in the financial sector to prevent future crashes and to protect the investors. Thank you for watching. We hope that this video helped you understand the causes, effects, and lessons learned from the 2001 stock market crash.